in the cabinet meeting today, the Union Cabinet went ahead and gave its nod for India's first debt exchange traded fund. It's an effort to strengthen India's bond market and bring in more retail participation. The cabinet launched what is called a Bharat Bond ETF that will support public sector units and other government organizations. The product will be managed by Edelweiss Asset Management and will have a fixed maturity period like all close-ended mutual funds. In fact, my colleague Mubina is with me now to talk more about these Bharat Bond ETF. Mubina, can you explain to us in simple language what it really is and why we should be interested in it?
You know, Tamanna, we're all aware of what an ETF is. I
Yes.
mean, an equity ETF at least has got pretty decent volumes, but sometimes when it comes to a bond ETF, not so much so. And I think that would be the key perturbing point. So firstly, a bond ETF, as the name suggests and no prizes for guessing, is an ETF that will invest in bonds. Like Tamanna as well mentioned, fixed maturity, you get an interest as well that's a bit better than your fixed deposit because obviously corporates tend to pay better interest than, banks. When it comes to a comparison as to how these debt funds have performed, I think the closest comparison to the Bharat Bond ETF would be your Franklin India Banking and PSU Fund or an ICICI Prudential Banking and PSU Fund, debt funds that is, and those have not done that bad. I mean, a 10 to 13% return in the last 1 year is definitely not bad. For the Bharat ETF fund, I think it's important to know they'll be investing only in AAA rated bonds. So you have quality that will enter. But again, who's to say, right? DHFL was a AAA rated bond and we know what happened over there. But yeah, I suppose you just got to enjoy the fact that, there's no concentration risk. You get diversity. Yeah. You get exposure to some of the jewels in PSUs. And of course, Edelweiss is managing it.
Absolutely. Thanks so much for that, Mubina. But is it a good idea for you to give us more perspective on that? Dhirendra, great to have you on the India Development Debate. Thanks for joining us. Let me get straight to it. Is the Bharat Bond ETF a good prospect for investors? Should we be interested?
Yeah, by its very design, this Bharat Bond ETF is something which is which will have huge appetite right now because Indian fixed income investors, India is largely a fixed income country. Indian investors have huge appetite for, the risk averse investors, they have huge appetite for fixed income. It is also reflected in this, if you look at the split of fixed income assets of mutual funds as compared to equity, fixed income is huge. So in that context, and the timing could not have been perfect. We have to see that how this actually pans out in terms of the two series, the two ETF, one with a 3-year maturity and the other with a 10-year maturity, carrying a AAA, with the underlying, being government bonds or bonds from government entities and AAA. So in that sense, today going by the kind of mess that we see in the for the fixed income investor, the kind of side pocketing that we are witnessing, the kind of defaults they are witnessing, this will come as a big opportunity. One has to see that how these ETFs evolve over a period in terms of interim liquidity, because the charm of an open-end fund is that mutual fund investors are able to take their money out at will. Whether this ETF will provide that avenue, will it have enough volume? And what will be the transaction cost? Because the underlying cost is 0.0005. Nothing can be cheaper than this. But this is just one part of the cost. The other part of the cost is that when you go to buy these ETFs, or when you plan to sell these ETFs, just in case you need the money before the maturity, what happens? Because and what happens if a lot of people want to buy? Because in case of the equity ETF, we have seen that those ETFs can be created at will, because the underlying being equity, it can be, equity is available for perpetuity. Bonds expire. So in that sense, there is a fundamental difference, and we have to see how it actually evolves in terms of liquidity, interim liquidity, and the transaction cost.
So Dhirendra, give us a sense. How does this compare, for example, to other options in the debt space right now? It's also linked to yields, which have been pretty shaky. So in that context, do you think it's a good prospect?
I think it is, it could be very attractive, because the first and foremost thing which crosses the mind of a fixed income investor is safety. And there, it is just a notch below the sovereign bonds, and substantially superior, because there is an implicit understanding that government entities will not default on their promise of repayment of principal and interest on time. So on that front, this is outstanding. We have, and also on the yield, I think it will be little higher than government bonds, and it will be little lower than AAA high quality corporate bond, private sector corporate bond. We have, the real issue is that what will be the liquidity? Will there be enough liquidity at a reasonable price without any huge bid and spread? If that is the case, then it will be a flyer, it will really take off. And we also have to see the efficiency with which these units can be created, assuming that the initial issue will be of 14,000 crore. But tomorrow, if there is another demand, or there's an appetite given at a certain yield for another 10,000 crore, how it will be created? Will there be enough supply, or supply on demand, or supply on tap? And how does government benefit from this? Because when the government actually disinvests the shares, the President of India gets the money. In this case, these are the respective, these are the borrowings of the respective companies. This definitely can deepen the bond market, but this money doesn't really go to the government, but to the government companies, and it's just they're borrowing from the government-owned PSUs. So one has to see how it happens, how it evolves. Looks attractive at the face of it.
Absolutely. Thanks so much, Dhiren, for joining us and explaining, why this ETF could be a good bet.